We're speaking with Leo Haviland. And Leo, let's talk about interest rates. What's the current U.S. Federal Reserve policy? Now, we're speaking on the 1st of May, 2014. The world is waiting to hear what the Fed is going to do next. What do you think is going to happen?
Well, on the federal funds rate, they're going to keep it repressed at the less than 0.25% level for many more months. Their goal, however, is to create inflation of at least 2%. So that means they're going to still keep a highly accommodative monetary policy. What they've done in the past several years, off and on, Scott, as you know, and still continue currently, is engage in a massive money printing scheme, which some might say is akin to counterfeiting. At any rate, they're doing a fine job printing. That should, over time, help to keep longer run and eventually shorter run interest rates, even if it takes several years, on the upside.
Why do they want inflation, even if it's only 2%? Why desire inflation?
You ask an excellent question, Scott. And really, it's a doctrine or ideology of the Fed where they believe inflation good, deflation bad. And that ties into a cheat the saver policy. And America has a culture of debt and entitlement, an enormous credit marketplace debt when you look at the federal government, the state governments, consumers, and businesses combined. It's massive. So inflation helps to reduce the burden of debt. Moderate inflation, nothing too massive, but inflation they view as good.
Are other countries following suit? Do we see Bank of China? Do we see the European Central Bank? Others doing a similar strategy?
Similar to the Federal Reserve. They too believe that roughly 2% inflation or so is an excellent plan. So cheating the saver is perhaps not a universal phenomena, but it's extremely widespread.
Mm-hmm. Leo, what are the chances that the European Central Bank will also follow suit and try quantitative easing?
They have hinted at it in their policy statements. However, I doubt they're going to engage in it anytime in the next several months for a couple of reasons. First, there's questions on its legality and whether it would be politically palatable to key members within the European community, particularly Germany. Second, they have an option of other measures, one of which would be negative interest rates.
Mm-hmm. So the Fed wants to see some inflation come along, but whether this will really happen or not and how long it will last, we don't know. What's your prediction for U.S. government rates as well as the federal funds level for the next couple of years?
The federal funds rate will probably go to around 1 to 1.5% in the next year to 2 years. Say, taking the 10-year government note as a benchmark, if we have 2% inflation, which the Fed seems determined to create, a 10-year yield of around 4% looks like a reasonable target for which one should forecast. And after all, Scott, 4% was the yield only a few years ago. In the summer of 2012, the U.S. 10-year made a low in its yield of just under 1.4%. Since then, it gradually has edged up to a high of just over 3% at the beginning of 2014 and still remains well above the 1.4% level that we saw roughly a couple of years ago. Now, although we're not up to the 5% level of mid-2007, it still looks as if we're having an uptrend in yields underway.
All right, let's talk about this taper that we're all anticipating at this point. It's going to have some consequences, intended or unintended. Talk about those consequences. What's the taper going to mean to us all?
We need to see, because stock marketplace's interest is so much, what happened in the past. And after the Fed ceased its money printing enterprises of QE1 and QE2, in 2010, after doing so, the S&P 500 declined. In 2011, that likewise happened. So although history need not repeat itself, since it's embarked on tapering in 2014, one can look for an eventual decline in the S&P 500 and various other stock marketplaces. So that also probably will fit a scenario of more economic sluggishness, slower GDP growth around the world than many would like to see.
Well then, where do we look for yield nowadays?
Well, some may say cash is king, but now because many persons around the world have hunted for yield by buying everything from equities to junk bonds to inferior sovereign debt obligations, capital preservation may be more important than wild, fervent, ardent hunts for yield.
Do narrowing credit spreads yield differences, for example, between a 10-year sovereign debt yield in Germany and Spain, or between U.S. government bonds and low-rated corporate debt? What are the implications of that?
An initial implication as they narrow could be improving conditions in the credit marketplaces as a whole. So the world is becoming arguably a better place in which to live and more prosperous. For, say, Spain, it could be that things are improving in their economy and their ability to handle their debt. And for corporations that are less than the highest quality, that may indicate that their prospects are improving. However, history indicates that once those credit spreads have narrowed sufficiently, particularly when there's anecdotal evidence about substantial marketplace leverage and a decline in credit standards, which we're seeing nowadays, that these very narrow credit spreads should worry audiences, and consequently one should look for a reversal in their widening.
Mm-hmm. Let's look at various scenarios for the U.S. interest rate increase. It's anticipated, but how is it going to come about? What do you see ahead?
Scott, the train has already left the station on interest rate increases. In July of 2012, the 10-year note made a bottom just under 1.4%. So although it edged up only to just over 3% earlier this year, that, given the money printing, the huge debt problem, and the Federal Reserve's effort to create sufficient inflation by their definition, that means the longer run interest rates are going to be going up. And the Fed has said that they're going to, at some point, engage in an exit strategy. And since they're at least tapering a bit now, even short-term rates will go up. So I think that over the next 2 or 3 years, there will be at least a moderate increase in short and long run U.S. interest rates.
Leo, we're at the beginning of May 2014. The equity markets here in the U.S. are at an all-time high. What if they fall? Are we going to see a flight to quality from investors around the world looking for government bonds?
It has in the past, Scott, and certainly in the initial stages, there would be a flight to quality into those financial instruments. It happened in the financial crisis, and it's happened several times since. You're raising an excellent point there. However, at some point, if there is this concern about declining stocks, if there's also significant fears about the overall United States debt situation, or should there be a massive weakness or increased weakness in the US dollar, that may not result in a flight to quality, and US interest rates may actually rise.
How important are foreign holdings of US Treasury debt, and what if those foreign holders of debt should start to sell it?
That would be the lookout below situation for US government marketplaces. The foreign official and private holdings are massive, depending on how you want to measure it, say over 40% or so of the US government marketplace. The Japanese own over $1 trillion, the Chinese own over $1 trillion worth. So if they sell, someone must buy. Perhaps the Federal Reserve will ride to the rescue on its white horse and do so, But if they don't, it would have to be U.S. investors. And why will they do that if they have no significant yield on those instruments? So that means higher rates.
Well, higher rates are what the world seems to be expecting now. And again, we're in the second quarter of 2014. But things don't always turn out as expected. So how strong are deflationary forces in America today? And maybe you can talk about deflationary forces around the world.
The deflationary forces probably are stronger than central bankers and others would like to admit publicly. The reason they want to downplay deflationary forces in the United States is that such fears would not only weaken equities and the housing marketplace again, but would spread fear through the consumer sector. And those forces probably are fairly strong because of the difficulty of propelling inflation numbers up to the 2% level here and overseas, despite the very low short-term interest rate levels, and despite the massive money printing festivities the Fed is engaged in. Japan looks as if it has escaped its long-run deflationary spiral. Over there, however, it hasn't resulted in much economic growth. Forecasts are still for about 1% or so real GDP growth.